All right, guys. Just going to do some a quick video here on the 10 rules of trading credit spreads. I base these rules off of some of the points that the guys over at TastyWorks used. I think they're very good. They're very valid. So I'm going to use those. I'm going to state those here. You can watch the whole series. You can watch the whole series of what that is. You can go to YouTube. And if you want to see their breakdown, you can see that. You go to TastyTrade on YouTube, open up the subscription channel, go down to playlists. When you go to playlists, what you're looking for is this one, Trading Options the TastyTrade Way. And if you look in here, here's the videos. Each point is broken down in detail. They have a whole panel here and they talk about each one of these reasons and why they're important and what's significant about them. I'm just going to give you a brief rundown of what they are. I like these rules. I think these rules are very effective, so that's why I've chosen to do this video on them. All right, starting off with liquidity. Number one, liquidity, you can look for signs of liquidity in the security that you're trading. So let's start off with SPY. You can see SPY has pretty narrow bid-ask spreads. That's good. It's got a lot of volume. That's good. That gives you some good confidence and indication that you can get in and out of the play very easily. There is a market for whatever order you want to put in. That's a good sign of liquidity. Another thing I like to look at when it comes to liquidity is come over to your watch list tab and open up something here. This is the watch list that I put together for you guys that for some reason isn't downloading. I like this. This is simple. I don't really got to do a lot of thinking. They do all the thinking for you. So that's cool. And you look at, your 4-star liquidity ranking, and you can go down here and you can look at something that's got a horrible liquidity. Look at Google. Let's look at Google. Look at Google, how bad their liquidity is. Pretty crazy spread. You got a 40-cent spread there. You got look at this. That's crazy. That's that's almost $1. That's funny. That's pretty rough. So that's almost $100, and actually that's $80 right there. See that? Oh, it's fixing itself. Not by much. So those are not really good things. You don't really want to stick to those. You want to be able to get in and out of your play. You want to see like there's a lot of volume in the contracts that you're trading. Those are the things that would be important in order to have those successful, or in order to stay following those rules and have that kind of success. All right, our next rule is going to be trade small and trade often. Now, why do we say trade small and trade often? The premise behind that is it's the law of large numbers. So let's say you take a trade here. Let's use AMD as an example because I have an AMD trade on. Let's go out to the quarterly. Actually, it's going to confuse me with that one there. Let's go out to the June 28th weekly. It's 40 some odd days to expiration. All right, as you can see, liquidity is decent. Volume's not really a lot there, but I don't know that I would have too much of a problem getting filled. If I wanted to, maybe, it's the weeklies can be a little bit tricky. I guess I'll just try and stick with the quarterly. It doesn't have those half dollars though. All right, so going back over here. So when we say trade small, trade often, you look at your position size. You look at your positions. All right, so let's say I want to do a put spread here in AMD. I already have one of these on. I have one of these AMD put spreads, and I have an Iron Condor on. So there's that. Here's a small trade. I got about a $3,000 account. That's about 9 to 8% of it. Take on 10 of those trades. That's a higher volume. Trading small, keeping your position size low. That's a concept that's commonly talked about amongst a lot of traders and various trading communities. It's a very good idea. But trading often means, there's that idea of don't overtrade. Well, when you're dealing with probabilities and you're dealing with a lot of this stuff, let me show you this. You got an 83% probability of profit of max profit of $25 on this credit spread. How am I going to realize you don't put your eggs all into this basket, because if this trade goes against you, your account's wiped out. But if I was to do these small little trades like this, how many times? Let's say 10 times. Well, let's say 100 times. 83 times I would get a winner. The other 17 times I would be facing losses, but losses can be managed. And that's actually another point that's brought up later on. Having having more occurrences, as the terminology is used, increases increases your odds, increases your ability to generate more return because you're doing it more often. So I would say before you take on using this system of trading, kind of understand that and study that and look at those points and look at these points that I'm talking about, because it can be contradictory to the do not overtrade rule that some people follow. I actually still listen to the over trading rule because look, I don't have a lot of positions. And the reason why is because I'm trying to work myself into doing this. All right, so our next rule we're going to look at is probabilities never lie. I've already talked about that. The math is incorporated into a lot of this stuff, and the guys over at Tasty, they make it easy for you to see a lot of this. You just look at the math, look at the probabilities, look at your expected move, and just stick with the math. If you have an 83% probability of profit, a 95% probability of profit, how many times do you got to do that, in order to prove that probability of profit? 100 times, 200 times, 10 times? The more times you do it, the more likely you are to see that return. But the numbers don't lie. The probabilities don't lie. This is mathematics. They're very. I like these. I like how options are priced. I like how they work. So, and the next point is implied volatility is overstated. Now, what that means is fear is overstated. People get scared. They overreact. They panic sell. That sort of thing. Volatility, you can always look at the volatility and where it's trading at. Just look up at the VIX. You can see that, and, you can see where it's trading right now. We're at 15. So there's that. Always check to see where volatility is at. Volatility is overstated. So what that means is in high implied volatility environments, people are kind of freaking out. There's some selling going on. There's that sort of thing taking place. But that does not mean that profit can't be made. Okay, so you look at high implied volatility and then you sell your spreads. So here's, this is really, really high IV. This is also that one. So let me go to something else here. All right, so there's 20s. High IV. Where are we going to find some high IV? You might find it on Facebook. It's been whipping around. It's not that bad. Let's see here. Let's just go over here to some of these other ones. Let's go to high IV. All right, so here's JNUG. Let's look at JNUG for a second. JNUG, look at the IV. Look at the IV. You got 80%, 90%. So here's the numbers you should think of. 0 to 25 is low. 25 to 50 is medium. 50 to 75 is kind of good. It's pretty good. And 75 to 100 is great. So that's what you're looking for when it comes to IV. And why do you care about IV is because when you're selling options, you want to be able to sell in high implied volatility environments, because as implied volatility contracts, because fear is overstated, because people get too scared and the markets stabilize and go back to where they came from, you get an IV crush. You'll get an IV crush in the form of a credit. So that's the kind of the idea there with IV being overstated. That's not as detailed as it could be. I would say check out the videos if you wanted to see that. Take profits and give losers duration. That's the next rule. Take profits. Let's say your max profit on your spread. Let's just use SPX because there are a lot of them. Say or whatever your max profit is. Let me see here. All right, so there your max profit $75 in this one, and this is going to change and fluctuate as I'm talking about it, so don't pay any mind to that. Your max profit $70. All right, so let's say I'm up $35 on this trade, $40 on this trade, $50 on this trade, and I only got maybe $20 left to go, and my sell strike starts getting threatened. Well, why don't I just I can think about closing that out at 50%. That's taking profits and giving and the idea of giving losers duration. Let's say this thing does hit my strike price. Well, and implied volatility goes up to really high. Well, remember, volatility is going to collapse. Volatility always collapses. If you don't believe me, I'll give you proof. It collapses. Let's use the VIX. The VIX is the measurement of volatility in the market. Let's look at 180-day. Look at how it always comes back down. It's always going to come back down. And actually, it's spent more time down here in this range than it's done pretty much anywhere else. Look at that. Look at that range down there. All these little spikes, yeah, whatever. You know what I mean? Really, whatever. I'm not concerned about all this. What I'm concerned about is, when this well, actually, I am. Let me take that back. I am concerned about these little spikes because these spikes right here are profitable. When you get an implied volatility that goes up, you want to sell into that stuff. That's good stuff. That's what you want to see. Now, if you have a loser, that's starting to set up, just know this: volatility will collapse. Okay, things will start to stabilize and kind of iron themselves out. So you can give trades a little bit more time if your strike gets a little too threatened. Like, what if it starts going down to 285.50 and my strike's 284.50 or 284.5? You know what I mean? Like, how do I manage that trade? Well, you can roll it out. And then what happens is, as there's a spike in this implied volatility, you recoup losses on this one as it fluctuates and goes back, and now you're collecting more premium out of there, and you're getting closer to break even. That's trade management. That's just an idea for trade management. Another idea you can use is you can roll out. You can roll farther out in time. You can roll down, up, whatever. That's managing your trade, and I'll get to that in one of the next points. Passive investing is destructive to wealth. Okay, so when you just sit in, let's use the terminology of like bag holding. You know, you're not participating in the investment process. That can be said that, you know, if you're trading spreads and you're not participating in the investment process and you want to put a trade on and leave it alone, it may not be the best idea. You want to be able to manage these things, especially when volatility goes up and there's things that are affecting the market. So, and the next point being active investing works. Basically what I've been talking about. Manage your trades. So, you know, if sold strikes get threatened, move them around. If you feel like your profit potential is good, you know, here, maybe I hit my $200 mark and there's only 55 left. Well, cut it. You know, that's managing the trade, taking profits, that sort of thing. Maybe you want to let it expire because, or whatever. Maybe you want to let this sell strike expire because it's doing good. That's fine too. So managing trades. That's part of active investing. And as I said, I'm going to repeat myself. If you guys need some further detail on this from people who are more informed than me, you can always go and check out the playlist for what they're talking about here. So our next point that I want to make is trading is a skill that can be developed. I don't really need to go a lot of detail into this one. And the reason why is because you guys just look at that flat out and see it's an obvious thing. It's a skill that can be developed. You can learn and improve your trading game. I would like to use myself as an example of that. You know, I'm a newer trader, and I would say that as I have learned and as I have developed my skills, I've been able to see more opportunities in the market and be able to capitalize on those opportunities. But that's because I've cultivated trading as a skill. So it can be developed, it can be improved. I don't want you guys to feel discouraged because you're losing money, and you know, everybody's going to lose a little bit of money at first, and then you get better. So just look for that. And the final point is be mechanical with positions, meaning that just look at things without, you know, have a plan in place before you get into the trade and follow that plan. You know, stay mechanical, meaning don't get emotionally involved in something. Don't get involved in it. Stay out of it. You know, let your emotions just sit on the sidelines, and then just follow some rules here. You know, if you have a sold strike that's threatened, roll or cut. You know, to either take your loss or roll it. You know, find new ways, find different ways to stay unemotionally involved in these things and be mechanical. Meaning that, you know, let's look at it like this. All right, I will always take profit at 75% of credit received. That means it doesn't matter how much is left. There could be $100 left on that spread. Cut it. That's a mechanical rule. That's a rule that you follow, and it's mechanized, meaning that you don't interfere with that. You don't interfere with that process. So that's kind of how that works. Another thing that's mechanical. Always, you know, look at your trades. Implied volatility is above 50%, 45 days out. That's a good thing to look at. You know, take that trade. You know, be okay with taking that trade and putting on the capital risk. Another thing is being mechanical is sticking to a 5%, 3 to 5 to 10% of your portfolio size for given positions, depending on what your size is. If you've got a really large size, you know, 1 to 3% would be fine. If you have a smaller size, 3 to 5% would be fine. I do like 5 to 10%. That's my take on things. And stick with that rule and be mechanical about it. Don't overextend yourself, and stick to the rule of trading small as well. So that's just kind of my idea on mechanical. I feel like that maybe, you know, I'm missing some stuff in that, but you know, mind you, I'm just rehashing a lot of the points that are kind of talked about here. As well as some of the stuff that I've observed in my trading. So if any of you guys have any questions about those, I'd like you guys to look at those rules. And if you have an interest in spread trading, that would be the way to go. Is kind of stick to those rules. But first rule always being, number 1, liquidity. Number 2, sell spreads or sell options in high implied volatility. trade small, trade often. The more position size, or more positions you take on, the higher the probability of success in that sense, because it's the law of large numbers. And never trade beyond a certain percentage of your portfolio. Probabilities are probabilities. You know, they never lie. IV is always overstated, meaning that people get scared and then they stop getting scared. That's usually how that goes. Take profits and give losers duration. We've talked about that. You know, what are you choosing? 50%, 75%? Are you looking to scratch it if it hits your strike, or how are you gonna manage your positions in that regard? Don't just take on a position and leave it alone. Passive investing is destructive to wealth. Yeah, you get stuck in something you can't get out of, and next thing you know, you're screwed, and your portfolio is screwed too. Active investing works. Managing trades. Trading is a skill that can be developed, and be mechanical with your positions. And that's pretty much the gist of it. And I think that if we can stick to some rules when we trade options, or when we can stick to rules period when you're trading, you're always going to be more successful. So that's my video. If you guys have any questions, feel free to send me a message.